Welcome to the simplest explanation of workers' compensation insurance coverage on YouTube. And any kind of simple explanation doesn't take a whole bunch of intro. We're just going to dig right in. So let's do it. Just a quick reminder, this is a part of our business insurance series. This is video number 4. So if you're trying to figure out how business insurance works, after watching this video, check out the rest of them. So what we will cover in this video, well, first, we're going to give you a definition of workers' compensation coverage. Second, we're going to give you what policy limits are and what that means. The third and probably the most important part is the 3 price factors. And then the fourth and probably the second most important is how an audit works. So let's get right into it. We're going to use this document to give you an overview of exactly the things you need to think about in workers' compensation coverage. This is the same document we use with all of our clients that work with Shine Insurance Agency. So what is workers' compensation coverage? Well, it's really simple. This is the coverage specifically for injuries to your employees or yourself as the owner of the business that could happen while working for you, right? So sometimes we get hurt. This is not for if someone slips and falls in front of your business that doesn't work for you. This is not for if someone sues you because of this, that, or the other that isn't an employee of yours. This is only for injuries that happen to employees of your business while working for you. All right, well, that was a pretty simple definition, right? So let's talk about policy limits. This is the coverage for defense and settlements based on your policy agreements, limits, and structures. Basically, you have a certain amount of coverage limits on your insurance policy that is the most the insurance policy will pay out. So if we come back to this document, on this document, the limits are right here. And this means $500,000 for any bodily injury by accident, and this $500,000 is per accident. So this is the most common one to be used in a situation. Someone working at a restaurant cuts themselves with a knife. Someone working in a manufacturing space is hurt or injured by a machine they are running. Obviously, $500,000 is a decent amount of money, but you can certainly see how the numbers would go above and beyond this. This is probably a good point to say that almost every injury that happens in a workplace has a value set to it. Not going to dig too deep into that, but it's actually like if you cut off a finger, we got a number for that. If something else happens, we got a number for that. So it's really, that works into the concept and the process. Again, this video is the simplest video, so I'm not going to go too deep into it, but essentially this would be a limit that would be placed on a claim or scenario. So the top one is by accident, and the next two are by disease. So let's say you had some kind of pollutant in your business and your employees became sick because of that pollutant. Then these are the numbers that would be per employee and then the policy limit. So if one employee had a $500,000 loss, then there would be no more than that available on the policy. So that is the limits, and I hope that makes sense. What are the 3 pricing factors? This can be pretty confusing sometimes, but I'll break it down really clearly for you. The first is the type of jobs employees do. I'll give you an example. I work in the commercial real estate insurance world a lot. If someone is a leasing agent, they sit in the office, and when someone comes in and wants to buy or rent an apartment, they help to rent that apartment to them. That is one kind of job and has one kind of price associated with the workers' compensation coverage. It's not likely to have a lot of injuries. But what about that maintenance person, the person who's doing the plumbing or who's up on the roof dealing with stuff? Well, that's obviously going to be a lot more expensive coverage when it comes to workers' compensation. So types of job the employee does is a number 1 price factor. The second one is the amount of payroll that you pay out in a given year for each job. So if you have that maintenance team and those folks get paid about $250,000 a year, then that particular type of job would have the payroll amount of $250,000 a year. So if your business has 4 or 5 different types of jobs, each one of those will have a payroll allocation set aside that you feel over the course of the next year is going to be paid out for that given type of job. And the last one is your mod, or the modification factor, based on how many claims you have had. And I'll give you an example of that as we go forward. So let's look at this example again. So we're down now here looking at this part. So we're saying, all right, in this example, we have 2 different types of employees. This is property managers. This is people people who are actually doing the property management part. And then in this case, we got another one that sort of is an all-encompassing, hey, anything in this space. So this would be a cheaper, a less expensive class code is what we call it, because this is, it doesn't say it very clearly here, but this is more like the leasing agents and people who are sitting in the office. And this is likely more the maintenance person or things that are doing work around the property. And in this case, the payroll has $37,000 of coverage for the property managers and $56,000 of coverage for the other type. So we have the classification here and we have the payroll, but we didn't talk about the mod. So let's dig into that modification factor real quickly. So a mod is basically a way of changing price based on your loss ratio or the amount of losses you have had. And so the mod is a multiplier of the insurance cost or the standard rate. So if you're a new business, you're probably just going to start at 1, and this will make more sense in a second. If you have a good claim history, that number is going to go down below 1, so that would be 0.99 or lower. And a bad claim history would go above 1 or 1.01 or higher. So let's put that in an example so it makes more sense. Let's say that when we put together the payroll and the class codes for your workers' compensation insurance, it comes out to exactly $10,000. This is going to be called the standard premium for that scenario, right? The class code and the payroll put together create a standard premium. But then we apply the mod. Let's say you have a good claim history, and so your mod is 0.91. We would multiply the $10,000 times 0.91, and that would, of course, make the price go down. In this case, it would make it go down by $900, and that's what you would actually pay. But let's say you have a bad claim history, a 1.41. That's a real bad claim history. So you have a 1.41 mod. Your insurance would go up to $14,100. So you can see that's a $5,000 difference, right? A $5,000 difference from one to the other. So it's huge. That is the effect that a mod is going to have on your workers' compensation insurance premium. Now, the last thing I'm going to talk about is audits. I've made a whole video on audits. You can click the link that pops up right here to watch that video, but I'll give you a quick overview of how audits work. So an audit is at the end of an annual insurance term. The insurance company is going to send you a document that says, hey, I need to see your books and I need to see the actual payroll and the actual job roles that happened in your business over the course of the last year. I need to see those actual documents. Remember, when we put the policy in place or when we had the renewal, we were estimating. We were saying at the beginning of the year, I think these will be the job roles that happen, and I think this will be the amount of payroll that applies. And we create a price based on that and your mod like we talked about before. But at the end, the insurance company wants to know the actuals. They want to know if your estimates were correct or not. And so you're required to send over real data from your accounting software. And here's the thing that gets people really confused in how this all works, because you made an estimate at the beginning, but you might have to pay more insurance for that year. In this point, it's the year in the past, right? You may have to pay more insurance for that year if you underestimated your payroll or the different roles you had in your business, right? So if you estimated that payroll for a given job was going to be $200,000 and it turned out it was actually $500,000, then you're going to get a bill for the difference from your estimate to the actuals for the last year. In the same regard, if you overestimate, then you're going to get a refund. I don't know if you've thought of this yet, but it's just like taxes, right? You say at the beginning, here's what I think my taxes will be. Then your actual payroll comes up at the end of the year. You do your taxes and you either get a refund or you pay. Workers' compensation insurance works the exact same way. You estimate at the beginning, you pay based off that estimate, and then an audit comes in and checks to make sure it was right. If you underpaid, they're going to give you a bill. If you overpaid, they're going to give you a refund. All right, there it is. Workers' compensation definition, policy limits, the 3 price factors, and then, of course, audits. That is it. That was the simplest explanation. I really hope that gave you the understanding that you needed of workers' compensation insurance without over-talking or anything like that. If you did get a lot out of this video, please leave a comment down below. And if you had a question, if you still have questions, please leave a comment below. We'll be sure to answer them. All right. Until the next time, have a wonderful day.